Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm interviewing Tim Whalen. How you doing today, Tim?
I'm doing good, Kirk.
Good, good. Well, glad to have you in the show. Why don't you tell us a little bit about your background?
Sure. Well, I'm an old Price Waterhouse guy. I've been with MLG for 34 years, but before that, I was in the San Francisco office of Price Waterhouse advising real estate companies about how to minimize their taxes, and came to MLG back in 1989 as a CFO and been in a leadership role as a CEO for the last 22 years.
All right. So what is it that you like about real estate?
You know, what's nice about real estate. It kind of it's so such low correlation rates to the public marketplace. It's not as volatile as the public markets. Has compared like the public REITs are highly correlated to the S&P 500, whereas private real estate has a very low correlation rate, even the public REITs, which is kind of counterintuitive because REITs have within them a lot of real estate. So private real estate is a whole different asset class in my viewpoint, and it works well as a great complement to the other asset classes and a great inflation hedge, as we've seen the evidence in the last cycle here of the impact of private real estate in portfolios.
So I'm curious when you say low correlation. I mean, I remember the last cycle, 2008, 9, 10, or 5 through 2010.
Sure.
Seemed to be pretty correlated with everything else during that cycle.
Yeah, it depends the volatility. A lot of what got hit in 2009-10 was really more on the development side. A lot of land development, single family got really crushed. But if you invested in multifamily, and multifamily asset values went down, but they didn't go down nearly as much as the public marketplace. It's significantly less as far as the amount of fall that occurred in the S&P 500 or the public REITs versus private real estate. And specifically, we have a lot of focus in multifamily. What asset class you are in, then real estate matters a lot. A lot of people like to lump, like right now, people talk about commercial real estate and they want to lump office with retail, with industrial, with multifamily. And all four of those asset classes operate very differently in different cycles. And there's a dramatic difference today for multifamily and industrial, say, for example, versus office. So it depends on what you're in and what happens in the next cycle.
So let's talk about that a little bit because I don't think I'm going to guess most listeners are not familiar with these cycles. So, what is it that's most attractive about multifamily? And then, as a follow up to that, like, what does the cycle look like for multifamily?
So, multifamily, the way I look at a multifamily, it's an asset class that really has the demand supply thing in their favor. All real estate is a function of demand supply on a very local basis. In the multifamily space, you have the demand side, which is extremely strong. All the demographic trends of people living longer, people getting married later, student loan debt causing difficulties for buying homes, all enhance the demand side. On the supply side has, it's been catching up, but the supply creation side was really behind household formation type numbers. And right now we're seeing supply side slow as rates go up and costs go up.
So, well, okay, so it's slowing, but I think that the fundamentals still hold true, right? I mean, if people can't afford a house at a certain price, it means that house is not worth that price; it's worth less. So, what
Right.
gives insulation to the multifamily when people can afford what they can afford?
So if somebody can't afford a single family home, where are they going to live? And they're going to land in an apartment complex. So challenges on the single family side, people's ability to buy a home increases demand for the multifamily side. So there's an interaction between single family and multifamily. And as there's challenges in single family, it does create and can create more demand for multifamily.
So when you say multifamily, can you describe that? You're talking about apartments? You're talking about like townhouses? You're talking about rentals or purchases? What does that
Yeah,
look like?
I'm talking about multifamily housing. It could be a 100-unit complex, it could be a 200-unit complex, 300-unit complex, it could be a 4-unit building. We focus in the larger 200 to 300 to 400 unit complexes. But we're talking multifamily housing, multiple people on one property.
Okay, and these are rentals, not purchase, right?
Correct. These are all rentals.
Okay. So, all right. So basically, you're picking up the rental market, and I guess the question would also naturally come if people can't afford to buy, then they rent. But at some level, a lot more people are renting, but they also can't afford certain things, right? There's certain limitations if we go into recession. So what gives that kind of insulated effect if for multifamily if we go into recession?
Sure. I mean, all asset classes are impacted by recession to a degree. And certainly the demand for multifamily in a recessionary period, people are going to move in together, they're going to move back home. So there will be softness, but I view that as a temporary condition. The permanent long-term trend for multifamily is there's not been enough housing, affordable housing created relative to demand for housing. And because of that, the long-term picture for multifamily housing is extremely strong because we really have a housing crisis here in the United States. We're not producing enough housing for the amount of people that are moving into the country, the amount of babies being born, and just household formation. So um, there will be temporary softness, but we'll work through that in every cycle. And when the softness, what happens is they start producing less product, but you still have long-term population growth, you still have long-term household formation growth. So demand sides continue to grow even through recessionary cycles. People still have babies. People still move into the country even in recession. So that demand side keeps on generating in our country, at least in the United States, and which helps you through all cycles and have quick recoveries when there's a recession.
Yeah, I mean, there's certain, I don't know what you would call them, rules of thumb or things that people say a lot, and that's one of them. Oh, we're always going to have more people or keep growing. But the demographics in this country are not showing that. The demographics in this country show that the growth of population is slowing, so much so that it's becoming potentially problematic. So, of course, growth is growth, but you also have a huge segment of the population. You've got the retirees that are retiring. You've got a whole segment of society that can't afford anything, whether it's because they can't afford it. I mean, there's no such thing as a starter home anymore because they're all too expensive. So it's hard for people to kind of move up the chain like they did. So they're moving into their parents' house, which of course reduces that demand. So I think the question I have is I hear this a lot. Well, why would real estate prices drop? Well, they can't because there's too much demand for them, and I just don't see how that makes sense.
Well, I think a lot of people in the industry, they want to generalize real estate as a whole, but you have to break it down to its pieces. And
Right.
what's happening in single family is very different than multifamily, than very different than office, very different than retail, very different than industrial. So you got to kind of break the pieces apart and then analyze each one separately. Right now we're still having really positive, strong household formation numbers, which is a combination of immigration, general population growth, or even people living longer, or people getting married later. All those things add to the demand for household formations, and certainly on the multifamily side and single family side. But you do mention single family struggling on affordability, and you just can't build affordable single family housing. And you really can't build affordable multifamily housing. The math isn't really good for that. So you have supply issues. That supply is going to be tempered because of the cost issues of grading it. Therefore, the demand side generally outpacing supply growth overall.
Okay. Yeah. I mean, those are fair points. I agree with that. Let me ask you this because I think one of the I've heard a lot from a lot of different people. Multifamily is the fundamentals look attractive. What other areas, given the environment we're in, which is kind of a tough environment for real estate, what other areas are also attractive, and then what areas would you just completely steer clear from, in your opinion?
Well, multifamily, the one thing that you have to remember in private real estate, it's a fractured, fragmented industry, and there's a lot of people involved in it, and there's varying degrees of talent. So human error is real in private real estate. So, the main thing in private real estate is, am I going to find an asset, whatever asset class it is somebody making a mistake operating an asset? They lack the capital to improve it. Are they not improving it? Are they not taking care of their customers? So again, that fractured nature creates opportunity just by itself, overall. Um, so if you look within the asset classes, certainly multifamily industrial are, in my opinion, the best asset classes to be investing in. They're both have good demand metrics relative to supply creation. Retail is actually surprisingly better than people realize. If you stay away from the malls, there's still demand for people to go to shopping centers, and especially in well located situations for retail, that there's demand for that product. If you're in a not a very good location, then you'll be very challenged. Office had problems long before COVID, and I call it the CEO problem. It's the big ego guy wants to, and man or woman wants to build a new building because they want a cool, sexy new building for their employees to see or customers to see, and they move out of that older building that they could have easily stayed in, but they move out of that building, even though it's a lot less expensive to stay there. They build a new building, so you always had the supply creation problem in office, and then on top of it, you just added COVID and work from home thing. So the demand side has even gotten softer on the office side. But you always had a supply problem as well. So office has got systemic problems that existed before COVID and just got further exaggerated with COVID overall.
So what do you think happens with that? I mean, we had somebody in the show recently, they were talking about how the LA office market has a 30% vacancy rate. So, what's going to end up happening there? Because I don't see the trend changing with work from home. And I know employers want people to go back to work, but employees don't. And so it's not going to reverse quickly, if at all. So you've got this extra supply. What do you do?
Well, you're going to see a lot of conversions probably to multifamily over time. But the only way that happens though is the ownership and the banks are going to have to take a hit on that, because what office buildings sold for, you can't buy at that price point and convert to multifamily makes sense. So there's a lot of money to be lost in the office space coming up here. I do believe people will work more together. I think I would describe it more as changing needs and the way people lay out their office space. I believe in the concept of social beings and people wanting to be together, work together. I think the current trend of working remote is really the younger generation. I have 8 children, and I get the range from 20 to 35, and I encourage my kids to go to work to get to know people and build relationships, overall. So I do think that trend of working remote will be somewhat muted, but it's not going away. It'll be less of an impact than people are seeing today, in my opinion.
You got 8 kids? You're a saint. That's a lot of kids.
My wife and I think we're crazy, but it's like getting on a roller coaster. Once you're on that ride, you can't get off. But it's a blessing, but it's also a ton of work.
Yeah, it's funny. My wife tells me like stories she talks about with women, how like, they have a kid and they're like, oh, I'd never do that again because the process was so obviously taxing and all that. And then like a year later, they're like, oh yeah, let's have another kid. Like they totally forgot
they
the
forget
pain they went through. It's like a hormonal thing that's like, oh yeah, it'd be fun to do that totally again. Yeah, it was easy.
Sure, no problem. Well, it's good that women have babies, not men, because there'd be a lot fewer babies out there.
If men were having babies, we would have been extinct long ago. So that's how I look at it.
Yeah, no doubt.
Yeah. So no, it's interesting though. So yeah, because I'm very curious, because people have been talking about how the banks are going to take a hit on the commercial real estate, but big question is when. Because I mean the whole banking sector got crushed after Silicon Valley Bank, and a bunch of other banks had some issues. And I don't know if you have any insight into this, but to me it'd be very interesting, especially for opportunities, to know, when all that's potentially going to hit the bank balance sheet.
My opinion is strictly in office. I think the other asset classes are fine.
Yeah.
office, I mean, multifamily, industrial, retail are all generally fine. It's really an office space. So if you have a bank that's got a heavy concentration of office, there's pain to be had there. So it's really a case by case basis. The whole regional bank problem really was a relatively small handful of banks that did a poor decision on matching investments with their deposits. I mean, deposits are basically short term loans to a bank, and they invest in long term securities, and that's a problem. I will say in general, you have to have banking in capitalist society. You need regional banks, local banks. So this concept of taking deposits, investing in loans generally is how banks work. So I don't think that goes away. And I don't think you're going to have a systemic crisis from that. But there's going to be isolated banks that got too heavy in office, especially in major urban areas that had major move outs and fallouts. Are going to have major problems, and it's going to be spotty bank by bank.
Well, one other question to touch on before we kind of go into another area is getting back to multifamily, really commercial in general, right? Is that, you know, the numbers are what the numbers are, right? You buy a property, you get a, you know, you get a mortgage for it, you leverage it up, and you get, you know, whatever you get for cash flow.
Yeah.
But the problem is a lot of that commercial property had 0% interest rates for a very long time. So very low rates, and they kept getting lower until 2022 when they started to spike. But every 10 years, that paper rolls over. And now you're getting a lot higher rate than you were getting before. So I guess the question I have is it's not supply and demand. That's only part of it. But you've got the challenge of, hey, this was I mean, there were a bunch of commercial properties that were getting like a 2 or 3 cap because, hey, we got to put our money somewhere and we need to put it in real estate. So, I mean, these big institutions were just throwing money at wherever they could. So 2 or 3 caps may be attractive in a 0% market, but it's not attractive in a 5% market. So,
yeah, I mean, you're singing to the choir here a little bit in that how you buy and buy side discipline is critical. And what you're talking really about when people are paying those super low cap rates generally was on the coast, East Coast, West Coast of America. Came middle America, it was a little more sane. And the key is when you're buying real estate that you buy with the reality of the current economic environment. It's like right now, I love putting money to work right now. I love the fact that cap rates are higher. I love the fact that we're borrowing money at a higher rate on a temporary basis because I believe long term with the government having $31 trillion of debt that they can't afford runaway inflation and they have to get inflation in check, which will bring the 10-year back down again. So I think we'll be selling at lower interest rates when we sell 5, 7, 8, 9 years from now. But you know, the one thing you got to remember in real estate, especially like multifamily, we've had material rent growth in the same period of time. When you have interest rates going up, you have to ask what's causing those rates to go up. And if rates are going up because of a combination of economic strength or growth, and that's causing rates to go up, we're also getting the demand side that is driving rental rates up. So really, we've had enough rent growth in multifamily to offset the effect of higher interest rates and higher cap rates. So even though we borrowed money at 3%, and we were disciplined, and we never assumed on the exit that we were selling for 3 cap or 4 cap. We typically are assuming 4.5, 5 caps on the exit. So we had room for rates to run in our mathematics. So buy side discipline is critical. And if you have a strategy to grow operating income, growing your EBITDA, growing gross rents, the power of rent growth can offset the effect of higher rates, interest rates, if you're structured correctly. If you're doing floating rate debt, you're in trouble because you didn't take away the interest rate risk. We always believe in having fixed rate debt. So we didn't play the game of floating rate debt. And by doing that, we're locked in for 10 years. So we have 10 years to get rent growth to offset the effect of any kind of movement in interest rates. And in fact, in general, we've already had that rent growth to offset that effect of higher cap rates from higher interest rates.
Yeah, and to be clear, I certainly the higher rates now, if you were to buy them now, you probably have better rates. But what I'm saying is like the stuff that was already in existence that has to roll over and people have not accounted for it. I mean, what should people be doing if people own that now? I mean, you've got a 2 cap or 3 cap, and rates have effectively payments have doubled, and may not be able to support that in a positive cash flow situation. So how should people handle that? Because you can't. It's too late to get out now.
Well, I would say somebody that paid a 2 or 3 cap on an asset, I go, why the heck did you ever do that? I mean, buy side discipline. At some point, rates we're gonna go back up. So people that did that put themselves in a bad spot. Frankly, no different than Silicon Bank did. That they invested in long-term treasuries within 60% of the deposit base. That got them in trouble, right? And so people that don't have discipline on the buy side in our industry are going to feel the pain of that. If somebody did floating rate debt, they're hurting right now. If they paid a 2 or 3 cap, if they paid a 5 cap or 4 cap and they did floating rate debt, they're hurting right now. Now, if you did fixed rate financing and you borrowed money for 10 years, fixed at 3%, and you paid a 4 cap, you have actually positive leverage on that cash flow, and you have 10 years to get rent growth to offset the effect of higher interest rates in the back end when you sell them. And in general, in the multifamily space, we've already had the rent growth sufficient to offset in the last 2 years. The rent growth that we've had is sufficient to offset the decline in value from cap rates in general.
Okay, so it sounds like you got to put the value add in there to increase rent growth, or else you're kind of SOL if if you're not increasing your cash flow through that 10-year period. Because I mean, there are people who are their stuff is rolling over now, right? You don't have that kind of time. Is my point? Like, you bought it 9 years ago, so within the next year, it's going to roll over, and you got to cross your fingers and hope the Fed drops rates, which is my next question to you, which is, hey, we've been in this environment for the last 20 years where everyone assumes the Fed's going to bail everybody out, but right now we have 5% rates, Fed funds rate, and we're getting 5% treasuries, and the economy seems to be plugging along just fine. Why would they lower rates? There's no incentive to lower rates. I mean, they might. I'm not saying they won't, but like, to me, it's like, why would you lower rates? They're fine where they are. So, if it's causing a disruption, you're causing a recession. Okay, great. Let's lower rates. Like, I'm not in favor of that, but I can understand the methodology. But there's no recession, so why would they lower rates? And that's kind of where it gets into this question of like, what's going on, and what's the direction going to be?
Well, my personal opinion is our federal government can't afford consistent higher rates. They put themselves in a pickle, $31 trillion in debt. They're going to see about 200 basis points increase in interest costs over the next couple of years. My opinion is they can't afford it. A 2% increase in our treasury debt is the same as our entire defense budget. So it's a material problem that our government put themselves in. They got to work themselves out of it. So when I think the mandate is for inflation rate closer to 2%, they're going to do what it takes to get it down there, because I think they have to, because they can't afford rates to run. They need a lower rate paradigm in general. The short-term rates and long-term rates. Now, short-term rates, I would argue to you that they probably will stay in this level for longer than what people think, because of what you just said. But I think the perception is, as they get inflation, the 10-year treasury is more a reflection of what inflation expectations are. And if they get the inflation expectations back down to the 2.5 range, you typically see the 10-year about 50 basis points above that, and you'll see the 10-year back down to a lower level. In real estate, it's more driven by, I'd say, investing in real estate, it's more driven by long-term rates than short-term rates. Real estate's a long-term asset class, especially in the private side. And my belief is you need to take away interest rate risk when you invest in private real estate. You take away the interest rate risk, and you focus on buying assets that you can grow your EBITDA, you can grow your net operating income, you can grow your gross revenue. That's how you create value in real estate. And you don't need to take interest rate risk. You don't need to be gambling on interest rate risk in real estate. And in my viewpoint, the best defense is strong offense. If you don't have a strategy to grow your EBITDA, your gross revenue in real estate, you shouldn't probably be buying that real estate in general.
Yeah, no, that makes sense. I would agree with that. All right, so let's kind of move on a little bit, because we talked about before the show, we talked about the fact that you can actually, if you're buying real estate, you're going to get a certain yield, but now you've got treasuries earning 5.25. I mean, I think it was seeing 5.3% yesterday. I know the listeners may be hearing this a while after, but I was looking at 5.3 in the short term, and I think 5.1 on the 1 to 3 year. So the curve has been flattening out at the short-term rate, right? The short-term rate spiked up. I think right now it's about 5.3, 5.2 for the 1 to 3 year. So that's even going up. So it seems like it's flattening out around 5. I mean, my prediction was that we're going to have higher rates a lot longer than most people think. Now it sounds like you kind of have a similar theory, but your theory is that it's going to remain in the shape of the curve, where it's high on the short end, and it's going to go down on the longer end, which I hadn't even thought of. I think it's actually an interesting thesis. I'm very curious if that holds up in the markets, but I can see how that would make sense, but the government doesn't necessarily control the longer end of the curve, so I'm not sure how they're going to manage that.
Yeah, if you go back and study long-term 10-year treasury rates, there's a lot of correlation to the inflation rates, long-term perception of inflation rates. So, my belief is if the gap's too, more money will go to long-term treasuries to the extent they believe inflation is going to be in check. And the same thing with investment private real estate. Right now you're investing for real estate when rates are higher, and in any kind of bond instrument, you want to invest in rates when they're higher and sell them when the rates are lower. That creates a capital gain as well as your yield. The same is true in private real estate. If we can put money work today at these higher rates and higher cap rates, we're likely selling the rates are lower, in my opinion. Now, we don't assume that. We assume that interest rates stay high and cap rates stay higher. And that's gravy in our mathematics, So I think it's a phenomenal time to put money work in bonds. It's a great time to put money work in private real estate. You just got to be disciplined in how you do both of those.
No, it makes sense. Yeah, because I mean, I guess I kind of look at it and say, well, if you're getting 5% on U.S. Treasuries, which is virtually guaranteed, as close to that as you can get, depending on where you are in the curve, but effectively you're getting, as close to guaranteed as you can get. Versus taking some risk in any other asset, real estate or otherwise, doesn't matter what it is, right? And I look at, and what I find comical is, I look at other things on the curve. You get into a AAA corporate is getting a lower rate than a treasury and a CD. CDs are 5.4. And you're getting AA corporates at 4.9. So what I find interesting is you have to go to like single A corporates to get a rate that's higher than U.S. Treasuries. And I guess not surprisingly, people don't trust the government, but it's just looking at the options, what's available. It just kind of makes me wonder, like, what would you have to get in real estate to make it attractive? Like 5% is pretty good.
We think we can hit for investors roughly, it's called a 12% rate of return, all in with the cash flow and appreciation. We say 11 to 15, but 12 to 13 is kind of where most of our performance come out and stuff from the buy side. Mm-hmm. And plus, and those yields, you also can look at, remember I told you I was a tax guy. You got to look at what do you put in your pocket after the government takes their cut. If you're buying U.S. Treasuries, you're paying the maximum tax rate, so you roughly 50% tax rate. So if you're earning 5, you're netting 2.5. And if I can produce a 12% rate of return, I'm only paying. I'll be paying on the cap gain rates on that income because of all the tax benefits you create in private real estate. So at 12, you're netting 9 after tax. So 9 after tax versus 2.5% after tax is a dramatic difference. If you just use the rule of 72, at 9%, I double my money every 8 years. At 2.5%, you're going to take almost 30 years to double your money versus do it in 8 years. So I can double my money 4 times almost in real estate versus 2.5% net after tax. That's a monster difference. You're looking at, your $1 million being whatever 4 times X. So you go 1 to 2, 4, 8, 16. So you have 2 million versus 16 million, in 30 years from now. So there's a dramatic reason. There's a big cost of liquidity and that safety.
Yeah, I mean, you're obviously still taking risks there, and there's some assumptions built in, but it makes sense. I mean, so before we kind of wrap it up here, you talked about some of the tax benefits from real estate.
Yep.
Um, can you get into some strategies that people can use to kind of improve the return on real estate on kind of different aspects, whether it's holding or whether it's selling, or some different strategies that you've seen as a tax guy? Um, Tell us what we can do to save taxes.
Yeah, I love uh, paying cap gain rates, not paying ordinary rates. And we can do that in private real estate. The biggest thing that not every real estate guy does is what I call cost segregation studies. When you buy an asset, you allocate your purchase price, get your maximum depreciation type deductions. So with that, you can basically shelter basically all your ordinary income with that strategy. And so when you earn cash flow, until you're selling the asset, you're typically not triggering your gain on sale or any income. So when you earn a 5% cash flow, it's 5%. It's tax deferred. You owe the money eventually, but it's a 5% tax deferred return versus 5% that they have to the government on. Overall. So again, the systematic approach now, multifamily is much more dynamic than retail offers from industrial for income tax purposes. The multifamily has different shorter depreciation lives. And there's things like bonus depreciation, which are bonus depreciation is going to be phased out here. But one of the biggest things really is multifamily investing and doing cost segregation studies. That's the real art to maximizing tax deducts for individuals.
Is what size property makes sense to start looking at cost seg? Because I know there's some kind of limitations there. You'd have to be a certain
Yeah,
size to make sense.
yeah, I'm a believer it makes sense in most anything that we do. And we're the smallest thing we'll buy typically is 150 to 200 units in size. So, we're only spending roughly $8,000 on a cost seg study. So it makes a ton of sense for us investing at the size we do. Now that you start going down to the mathematics, buying a 16 unit or 32 unit building, it's probably starts thinking about it a little bit more. It's really mathematical analysis. You look at how much additional depreciation deductions you can get. What's that worth to you versus the cost of the cost seg study? My guess is somewhere around that 32 unit building size would make sense to do that.
Okay, yeah, that makes sense. Um, all right. So as we kind of wrap it up here, what are some final thoughts you can leave our listeners with?
Don't be afraid. In life, there's a big cost to running and trying to be a market timer. A lot of people try to be a timer in the stock market. It's proven that you tend to generally underperform when you try to be a market timer. It's also true in private real estate as an asset class. I think it's a great time to buy. We bought all through COVID. Yeah, there were some challenges in there, but you just have to be real about the assumptions you're making. We talk about in our business about making smart investments. It's really about, am I making assumptions to buy a deal? Are the assumptions I'm making, are they believable and are they achievable? And if they're believable, achievable returns, and I'm looking to produce a 11 to 15% rate of return, and they look like assumptions that are really likely to occur, it greatly reduces the risk, overall. We also pair that with lower leverage. We do lower leverage in our industry. We typically do 60 to 65% debt. The industry allows me to go up to 75, 80% debt. And again, doing lower leverage takes a lot of risk out of the platform. And also doing it in a fund structure. We got our typical fund has 30, 35 properties in it. Again, getting away from single asset risk, no different than buying an ETF versus buying single stock. So doing things that create diversification, reduce risk, reduce leverage, and be real about the assumptions you're making. And life's going to be good. And we're really happy to put money to work right today in private real estate at this higher interest rate environment. Because we're going to be selling when rates lower, in my opinion. But we're not assuming that. But that's nice gravy and performance of everything we're doing.
Nice. Well, Tim, I appreciate you coming on the show. Where can people find more about you?
Well, the company's called MLG Capital. So it's like Mary, Larry, Gary, MLGcapital.com. Just take a look up there and we'd love to help you out, help to get diversified in private real estate and show you all the benefits we can create from an income perspective, as well as from an income tax perspective as well.
Okay, awesome. Well, Tim, I really appreciate you coming on the show and sharing your wisdom with us. I'm sure we'll have you on again as real estate is it's not going away, and we're going to probably have a lot more to say about it in the next few years, given all that's going on. So thanks for coming on the show.
Kirk, appreciate the time. Thank you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. Mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right, that was a great interview with Tim. Really appreciated him coming on the show. Always love having people who are former accountants because you know their numbers work. But now we're in the panel portion of the show where we have our own Doug Heagren. Hey, Doug.
Hey, good morning, Kirk. Nice to see you again.
Yeah, good to have you on. Well, today it's a special. We never have these. This is just me and Doug. So we recorded this in August. Everyone's on vacation. Doug and I decided we're going to come back and make sure we do it right for all listeners. So that's why it's just the two of us. So don't dismay because you'll probably see us on Friday anyway. So Doug, what were some of your takeaways from the interview?
Listen, I mean, he obviously knows what he's talking about. His background is in this area. I would say the last decade or so, of all the areas that have really shown to be resilient, if not resilient, just high growing, it's residential, right? We've talked about it all the time about how the rental rates have gone up. Average mom and pop, we've got some data that shows who's involved in buying real estate and trying to rent it out either through long-term rentals or short-term rentals. Whatever the case, it's the buzzword. It's the place to be. And those that know what they're doing have had a tremendous amount of success in it. I look at over the last decade, some of the REITs that I've seen, and for those that don't know what we're talking about, real estate investment trust, package, securitized real estate. Some of the best ones that have been out there have come and go, flash in the pans. Boston Capital. There's a handful of others that created these residential REITs that were just absolutely did wonderful. As we've talked about in a low interest rate environment, it's been a real boon for the price, for the valuations of residential real estate. People have needed a place to live, and so whether they've been renting it or whether they've been buying it, there's been a tremendous amount of opportunity. That has not been the case in some of the areas he's necessarily stayed away from. He doesn't like commercial real estate. Well, guess what? COVID proved that's going to be a challenge for a lot of organizations. I mean, commercial real estate can be smooth and steady, but I think we've got some serious headwinds against that. Where he's not been he tries to stay in areas, it sounds like, that are not necessarily as as big of highs and lows like the coast. He's looking for really good places to, that are going to have maybe more stable, calm, and steady, economy. And I've said this for years. I think if you can do it right and you understand it, multi-tenant residential housing is probably the best residential place to go, because you have lots of people paying rent, splitting your fixed costs. I still to this day don't understand owning the one property and trying to rent that out with 100% feast or famine. And it sounds like he's really built an incredible business in this area, and he's doing really well.
Yeah, no, there's a lot of truth to that. And I think, what's I find interesting, because we've not brought on a lot of real estate people on the show recently. Now, you might recognize that because we used to bring them on all the time up until last year, when we thought, you know what, real estate's getting a little peakish. We're not seeing a lot of extra, I guess, alpha being generated from bringing people on, because they're talking about the same stuff and everything looks great and dandy. But now we've kind of paired that back with guests, and we're really just bringing on guests who have something really interesting to say. They have a more interesting background, because, frankly, real estate is in this place where there are still people buying up real estate they shouldn't be buying. I mean, we do a lot with private mortgages with our firm, and what we see is pretty much the last 4 years, the market's dried up. And we work with a lot of investment sponsors. And so we see what they see because they share it with us. And they've slowed down their purchases because they couldn't make the numbers work. Now, up until last year, at least it may still be going on, but the last time I spoke to them, up until last year, they were talking about how they were bidding on properties. And let's say hypothetically, because I don't know the numbers off the top of my head, but let's say hypothetically they're looking for a 20% profit margin, right? So you got 20% profit margin, that bakes in some margin of error, right? Because sometimes there are mistakes. You still want to make money. Maybe you only make 5%, but you kind of bake in a little buffer. Any good business person will do that just to make sure that they're not going to lose money in a deal. And so their typical, let's say, is 20%. Well, there's people out there grabbing the deals. They're paying more, and they're saying, well, our buffer's only 5%. And they're looking, and the guy was telling me, he's like, I'm scratching my head thinking, who's this idiot who's bidding on this property? And it's a bunch of new people in real estate saying, hey, I want to do this deal. I only want to make 5%. He's like, take it. I don't want that deal. You take it, right? And what we've been seeing is a lot of the smart developers, rehabbers, renovators, fix and flippers, they're just not doing deals. They're sitting on piles and piles of cash, which is tough, although it's not as tough when you have 5.5% US Treasury short term, but they're sitting on piles of cash and they're thinking like, all right, well, I can just pay cash for deals. I don't need to borrow anymore, but they're not seeing as many deals. And so when you get in this environment, which has gotten worse, by the way, because at least in the last few years, when I was having these conversations, you could make the argument and say, well, it's 2.5% rates. Okay, I get it, right? But now you get 8% 30-year mortgages. The numbers are drastically different. And so you've got buyers that are disappearing because they can't afford it. And yeah, stuff's still moving, but stuff's not hitting the market. And we'll talk about that a little bit later in this episode. But if you think about it, you've got a drastically changed market. And people are still out there doing the same stuff like, hey, everything's great. Nothing to see here. Remember that Naked Gun scene with Frank Drebin in front of the fireworks factory? Nothing to see here. Go about your business. Nothing to see here. And there's like explosions in the background. Like, I feel like that's what's going on in the real estate market. Like, oh, everything's great. Yeah, I'm just buying. It's easy. And when we have people come on and talk about office space, we had a guy on, I forget who, I'm not sure if he was before or after this episode goes live, but we had a guy talking about office space, and he's like, yeah, it's a mess. Like 30% vacancies in office space in LA and New York and some of the major cities. And people are saying, oh, well, they'll just kind of refit it, right? We'll turn it into residential. I'm like, yeah, how's that going to happen? Because office buildings don't have the same piping that residential needs, right? You might have one wall in the middle of the whole floor. Residential, you need like 20 walls with like wet walls and stuff going up and down. So it's not that simple. And I guess the point is when you're looking at these markets and you hear these headlines and say, oh yeah, that's fine. You got to look deeper, because it's not always, the people writing the headlines aren't always adept at these areas. They're just trying to put out news that you're going to read. So as we kind of get into this, and let me pull this back here. Hold on a second.
Hey, Kirk, while you're pulling that up, I want to add on what you just said. I think the opposite exists more than what you mentioned. I remember after the 2007, 2008 recession, there were a lot of residential buildings that were converted to commercial. So instead of people living there residentially, they sold them off as office condos. That actually works really well because they're basically double engineered for residential, easy to turn into commercial. And if you were one of those that required it, what a fantastic place to have an office. But you've got another thing, not only do you need twice as much in that, the codes for residential are so much more strict. I was looking at a stove one time. It was an incredible commercial stove. They said, you can't put it in your house. I go, why? He goes, it's not up to code for residential. So if you try to take a commercial building and just convert it to residential, you're going to have to double your expenses just to bring it up to something that you can legally use for residential. And I don't think people understand how costly that really is going to be. And as you just said, that's already on tight margins.
Yeah, and what's interesting is I'll give you kind of a personal story. So our office, we bought in an office condo. So we were leasing in an office condo in our area, in the Boston area, in the suburbs. There are not a lot of office condos in the area that we wanted. There are a handful, but there really aren't many. It's actually, I found it quite fascinating because if you're looking at the big office buildings, yeah, you get big corporations, but there's a lot of small businesses that need somewhere to go. There aren't many office condos. So we were leasing in a building. We're like, yeah, we want to buy as soon as one comes up. And when one did, we bought it. And it was great. I forget, it was like maybe 10 years ago now, but we had another one come up. So we had a neighboring office condo that's literally attached to ours. There's three. There's ours and two others. Someone bought this one. This other one was vacant. It was just sitting there. We couldn't even contact the person. Finally, we contacted them. They agreed to sell to us because we figured, well, it's connecting. We need to own it. We can't let it go to someone else. And so we bought it. You know when we bought it? February of 2020, Doug. Perfect timing on our part. Now, that being said, like we were kind of like, as we were closing, we're like, should we do this? And we're like, well, we have to, because this will never come on the market again. So we did it just because it was a long-term play. But, realistically, since then, we've had it for listing for rent because we don't need it. And it's just extra space. We've had it for rent. No, not one person is looking at it. And it's a great space, but no one's looking at it. So I find that fascinating because people working from home, they want to save money. Great. But in the office condo market, there should be a lot of small businesses that need a place to go. And surprisingly, they're just working from home. And this may not be, this is anecdotal. So it's not exactly, hey, the whole nation's like this, but it's interesting. I just find it interesting. So go ahead, Doug. You raised your hand. You wanted to speak about something?
I raised my hand to say I'm one of them. I've
Okay.
got a virtual office that I can go into if I need to meet with people. But what's the point? For my philosophy, I mean, how are we talking right now? We're using Zoom. 98% of all of my conversations now are being able to done virtually. And what's the point in the overhead? So I fall right into that category you just mentioned.
So yeah, so what's interesting is you think about it. There are some, I forget what they are. There's like two companies that do this, but there are companies that will buy up office space, and this happened 10, 20 years ago. Maybe it started with the tech bust, where they would go in and they would buy old office space. They would sublease it, or not buy it. They would sublease office space in an office building, nice space. And they would sub it out to, independent people, like small business owners, small business, maybe a handful of employees. And you could go in and you could rent a space. You could either rent an office like monthly, you could rent it for a day, you could rent it for an hour. And it's brilliant. It was a brilliant idea. And it was always people in there. And I thought, what a great idea, except they charge you through the nose. So we looked at that at one point. We're like, nah, we're not doing that. You're not going to, it's like twice what it would be to lease somewhere else. It just wasn't worth it. But for some people, if you're going to use it once a month to meet with a client, it's awesome. Now, what's funny is I was talking to a prospective client yesterday, and we were talking about the nature of, he was in a different state. And he's like, I'm thinking about, I'm talking to some guy local. He's like, I don't know. I kind of want somebody local. I'm like, honestly, I haven't seen more than 2 clients in the last 4 years. I have an office. You can come in and see me. I'm not saying no, but people have gotten accustomed to virtually meeting, right? So if you think about it, it's like, all right, I've got an office, you can come in and see me.
do you really want to drive like an hour to spend an hour, 2 hours driving there and back, then meet with me, and then you're like ruining half your day, right? Just to go meet with me. And I'm lovely, I have to say. Like, I'm a lovely guy. I'm sure I'm very acceptable if you want to meet me, but in general, people have changed their habits since COVID, right? And while I love seeing people, people are like, yeah, I'm cool doing this over the phone, and that's fine. So, I mean, we have a virtual business where we have clients across the country, but I think the dynamics have changed so much that a lot of people are working from home. They don't see the need to meet with people anymore, which is, to me, it's still a little weird. I do it too. I'm working from home right now. But I think the nature of things have changed, and they're not going back. And that's the piece that's really important when we talk about office space, as we alluded to in the interview, is you can think about, like, earlier this week, Goldman Sachs came out and said, you're coming back, or I forget how they phrased it, but it was like something along the lines of, you're coming back, but if you're not coming back, you have to rethink your employment here. There's something along the lines of what they said. Now, what's interesting is they're trying to push people back into office space. JP Morgan, I think, did the same thing. I think BlackRock, a bunch of the big financial firms are trying to push people back in their offices. Now, what I find interesting is they have these luxurious palatial offices. Some of them own buildings, and they're like, you need to get back in the office. Like, why? I mean, finance, there's not as much collaboration as there is in maybe tech, right? Tech, you want a bunch of engineers in the same room to beat it up. And I'm not an engineer, but I'm assuming there's a lot that you can get from that. Zuckerberg said this a bunch of years ago at Facebook, and he said, you get a lot from this, just being around other people, and just at the water cooler, they bounce ideas off each other. Law offices, my buddy works for a huge law firm, and he's like, honestly, the younger guys and gals don't get the mentorship if people aren't in the office. Where normally you just see them at the water cooler, like, hey, let's go grab lunch. I'll take you to lunch. We could talk about this case. Like, that's important in that field. Every field has its own little thing. Now, for me, like, with my team, I just set up time every week, and we just talk, like, hey, what are you experiencing? What do you need help with? But like, I think the dynamics of work have changed, and I don't think they're going back. You can't force people to drive an hour or 2 hours every day to go to the office when they could be spending that hour, 2 hours with their family. And, my wife works from home. Like, why should she drive? No, she has to once, twice a week. But if she doesn't, like, she gets more time with the family. I'd rather her be here than sitting in a car, listening to the radio for those hour, 2 hours, not even being productive. It's not like she's on the train. She can get work done. She doesn't have autopilot. She can't read a book. Like, so to me, it's just, it doesn't make any logical sense for the trend to go back. It doesn't mean it's going to disappear, but it means the trend is solidly in place in the moment, and there's not a lot of reasons for it to change.
Well, and I want to add something, Kirk, two things. First of all, the irony about the tech working together and collaborating is that systems like Teams and systems like Slack initially started as a way for people in tech to beep each other on collaboration. So they started, tech started the trend of kind of virtually being able to communicate. And the other thing I think it's really important to note is, as you talk about it, I mean, I'm up in Minneapolis now. Traffic here has gotten so bad that they put up billboards asking for more highways. Dallas, traffic was bad. You live in the Boston area, traffic was bad. People got to the point where at first they were resistant. They said, that kind of the old school mentality. I need to sit down. I need to see you. I need to build that trust. Once they started to kind of go in that shift direction of kind of the convenience of tech, guess what happened after that? COVID hit. Then they didn't have to go in anymore. And then they realized, wow, look how much of my day I'm getting back. I mean, it could, you said, it could be 30 minutes. It could be an hour to get to your office, have the meeting, come home. That person just lost 3 hours. Now they can click on, they can click off. And the other most important thing about that, Kirk, is they don't have to wear pants, right? I mean, let's face it. I don't know what's going on underneath the screen. I am wearing pants, so in case everybody cares.
So I don't want to know that, Doug, if you're wearing pants. But I will say, if you meet with me, that is a requirement. You have to be wearing pants.
Yeah. Hey,
and ideally a shirt too. Just saying.
As far as you know, Kirk, we all are, but you can only see to hear, right? So it's one of those things where, from a convenience standpoint, I think people realize it. And there's we talked about this in another podcast. There's new reports coming out that 4 to 5 p.m. now is the lost hour. Nobody's productive 4 to 5. This is the time of the day that people are now spending, picking up kids, doing groceries, doing other areas, their errands. It has become known as a completely worthless hour of the day. And what is that telling you? It's telling you we don't have time. People can't get done what they need done. So now, not having to get in that car and drive places is absolutely going to be more welcome than it ever was before. The other thing about the commercial business industry, commercial real estate industry, is that we also have changed where we're making money. Okay, more and more people don't work for a big collective organization. Goldman Sachs may be trying to get people back, but let's face it, their finance people can work wherever they are and be productive. But how many people now are in gig economies? How many people are making money through other service real estate? How many people are self-employed? They don't need to have dedicated offices where they, like you said, they're charging an arm and a leg for you to have this space and this wall. And then you got to come in and you got to pay for all the renovations to put your signs up, which is why the virtual office, and the co-work world has actually boomed. But interestingly enough what was that? WeWork tried to jump in on that. They're like, look, the world's going gig economy. The world's going self-employed. We got all these people that can just come in and share and collaborate. The irony is a lot of them don't want to collaborate. They want to have their own bubble. But the other side of it is the same thing. They over-invested in it. They charge too much. So basically, this would be the cost of having a dedicated office space. This is how much people need. WeWork and companies like that came in here and said, look, we'll make it cheaper. We'll charge you this much for it. Well, it's like, wait a second. I might as well go get my own place at that level of it. I'm still, versus having a door I can lock. I'm not going to pay 10% less for 80% less value. And so WeWork, for a number of reasons, overexpanded and was a colossal failure. But it is a trend that is continuing. There is more and more of these places there where when people need a commercial copier, when people need to have an office to talk to people in the rare occasion, they can just pop in, use it, go home, have their mail there so that everybody in the world doesn't see that their home address is their office place. There are some privacy things that make that valuable too. But times have changed, and a large segment of the population now is not going to be going back, or need to go back to the commercial environment it once was.
Yeah, I totally agree, Doug. I think we're in a different place. Let's share. We pulled up. We had some interesting charts. So I want to share some of these and let Doug talk about it as well. So we got some interesting charts recently where this puts things into perspective. Now, we've shared this on some of our Friday inflation deflation episodes, but this one's pretty interesting. I thought it was brilliant. 32 million owner-occupied U.S. homes have no mortgage. 32 million. Now, the number of owners with owner-occupied homes with a mortgage is 51 million. So approximately 37% of owner-occupied housing have no mortgage. Now, we think about it, we talk about like why you have people on both sides. You have this argument right now, affordability, which is the side we're on, versus supply and demand, which I think is important, but I don't think it's everything. Now you've got another factor in here. Owner-occupied homes have no mortgage. So if you think about the housing market, right? If you don't have a mortgage, then you don't need to move, right? Because you don't have that extra burden. And I would imagine a large part of these are baby boomers, right? They're in their 60s. They paid off their mortgage. They don't feel like they have to move. They're basically paying for taxes every year and not much else. You can lower your costs, and we talk about this in the show, and whether you should pay down your mortgage or not is always a big question, right? And it really comes down to either numbers or emotional. There's no right or wrong answer. It just matters which is more important to you. But I wanted to point this out, and we'll let Doug talk about it in a minute. And I also wanted to point out this other chart, which is thinking of selling. So this is, I don't know how they did this. Zillow does this, but it's homeowners who are warming up to the idea of putting their homes on the market. Now, I'm very curious how they did this. Did they do a survey? Did they, what was the metric on how they came up with this? But if it's true, and you always have to look at the data and question it, right? Because statistics are really good for manipulation of the conclusion. But if you look at this and say they're warming up to the ideas of putting the housing on the market, okay, well, it was at 15 to 20%. Now it's at 23%. Okay, great. It's going up. It doesn't mean they're actually selling because they can't. So I find it interesting that this is going up. We'll see if it continues because, like any trend, who knows? But I think at some point, some people are going to have to sell just because, we had somebody across the street put their house in the market and they, their kids are off at college. They got this enormous house. They don't need it for just the two of them. And they're moving, which they should. But where are they going to move to? Well, I guess they're going to have to downsize, take their equity and not have a mortgage, which may be playing into some of these numbers. So if we think about the homeowners that don't have a mortgage, maybe, and I'm hypothesizing here, so don't take this for word, but if you have a big home and then you sell it and downsize it to a smaller home, you pay a lot less. Well, you could take your equity from there, put it into the smaller home, you have no mortgage. So there might be a lot of that going on too, because this seems relatively high for homeowners that don't have a mortgage, because that's not typical. Typically, people pay it off over 30 years. They refinance. A lot of people don't pay it off, but it's interesting. So, Doug, what are your thoughts when you see this?
Well, a couple of things. I think you made a really good point there. I think there's obviously an opportunity to downsize. I saw something really funny on social media where somebody posted him. I have a 2.5% mortgage. I'm never moving. Her. I want to be closer to the kids. Put the house up for sale. We're moving, right? Yep. So there's going to be. I think we tend to dumb this stuff down into such into such little snippets of, well, people don't have to move because they're not going to move at these rates. Life throws curveballs. I love the old, I think it was Nationwide. Life comes at you fast, right? It does. Things change. I don't know the statistics behind the Census Bureau data. 38%. I know we had another chart we were looking at about who owns the wealth. There's still a lot of greatest generation people that are still here, that are still alive. I don't know how many of them are still owning or living independently in their own houses. That's got to be part of it, because if you imagine, as long as they've lived, they've probably outlived their the 30-year mortgage they paid off years ago. You've got obviously one other concern, and go back to the other chart for a second. So we know the 38%, the 32 million that have it. What I think is interesting about this chart too, it only goes back to 2021. So what was it before? I think the other thing is they make it really big, and say, look at this huge spike, but then, it's, as you said, it's like 15 to 23. It's not that much, but it makes it look much bigger, especially in relation to where it was. But what are some reasons people are warming to the idea of putting their homes on the market? I don't know. I don't know the relation to this, but something that comes to mind here is 38%, 38 million people might have paid off homes. Some of that might just be that they've outlived the duration of their mortgage and they've paid it off. Some of them expedited trying to pay it off by doing 15-year mortgages or putting extra payments down. I've talked about this ad nauseum about lost opportunity cost and the thoughts of, hey, why would you ever take extra money and put it down on something that has such a cheap interest rate? But people do. They get that emotional tie to paying it off. The problem with that is that a lot of the people that are now free and clear are finding that the cost of inflation, there's this idea out there that if I pay off my home, I own it outright. I'm going to make this very clear to everybody listening. You never own it. The government always owns it. It's called property taxes. And if you're in an area where, unlike California, what has kept property taxes almost problematic from a housing supply standpoint, because nobody's ever gonna get rid of them because they're so inexpensive through the homestead. Most places, property taxes have been going up significantly. And when that happens, all of a sudden you look at property taxes going up, you look at utilities going up, you look at everything else, food, clothing, everything else going up. And what a lot of people are finding, and I don't know how much, again, relates into some of this thinking, but what a lot of people are finding is, look, holy smoke, I got a fixed income, and it may not be fixed. Maybe they do have investments, but guess what? People don't want to pull out of their investments and exhaust those investments and create a fear of running out of money. And most people have one source of income, that's their Social Security, and their other source of income is all the assets that they have. And so they're seeing a need to constantly fight inflation by distributing more, which of course creates more of a desire to get more return in the market, which, as you know, Kirk, is out of people's control. They take more risk. 2022 tanked portfolios. I heard people that were multimillionaires say last year, well, because of the market, I was going to retire and now I just have to keep working. I'm thinking, what? This isn't 2008 where you lost 40% of your portfolio. You didn't even give back the gains you had from 2019, and now you have to keep working. This is how tight the majority of Americans are. So if these other variables like property taxes going up and inflation in other areas have created a situation where people don't have the cash flow, then yeah, they're going to start going back to even a paid off house, and or even a house that they may currently have some payments on, and turn around and say, gosh, I am seriously considering selling it because I've got to figure out how to create liquidity. We have a liquidity crisis in America, and one of the biggest causes of liquidity crisis for a lot of people, in my opinion, and I've seen the numbers, is this overzealous attempt to pay down debt and pay off their house, which basically transferred wealth to banks, and it's gone. And now they're going, well, where do I get money? And the banks are going, sorry, we're not lending to anybody because we suck at finance too. So there's a lot. I think there's a lot that can be read into that. But again, there's also a lot of variables we don't know in terms of the data behind those charts.
Yeah, no, I totally agree, Doug. And we talk about this on the show all the time on how, you can look at the data and that's interesting, but sometimes you have to kind of read through it, and don't let the data, don't let the statistics, don't let the meme or the tweet or whatever, don't let that influence you. And it's hard. I read this stuff all the time. I don't read the news because the news is all manipulated. You could say whether it's deliberate or not, it doesn't matter. It's not accurate.
I get my news from South Park because the most important things will be next week's episode.
It's funny how true that is, Doug. So brilliant comedy, by the way, especially for those who are into that sort of thing. But anyway, so I think what's important though is we when we share these on the show, it's really Doug and I, especially on our Friday episodes where we go live and then they come out on Wednesdays for the podcast listeners. When we talk about a lot of this stuff, we talk about the concepts and then the charts come later. Like, month, 2 later, because we're talking about concepts of what's going on. And then a few months later, it's like, oh, here's a chart that fits what we were talking about. We knew it was going on. We just didn't have a cool chart that somebody put together to show it. So, a lot of the stuff that we see is accurate because we're not looking at some meme or some chart or some tweet. We're actually looking at the data. And then when it comes out, it's like, okay, here's an illustration for those of you who need the visualization. Now, I'm a visual guy, but I like I said, I've been doing this for a long time, so I don't need a tweet to show me that. But generally speaking, it's really important just to keep in mind, like, you are being influenced by the information you're taking in, no matter where it's from. And it's not just major media, it's the dictionary, it's wherever. Whatever you're reading is going to influence the way you look at the world. And if you understand that, then you could be mindful of it when it's happening, because then you can say, all right, I'm reading this thing. This is really cool. How is it making me feel? So, for example, I just read an email this morning from a research source that I find reputable, and I was reading it, and it's like, it was talking about how the market could crash like 60, 70%, and we still could have that happen. And I'm reading that, and I'm thinking, all right, well, I believe that in my thesis that in the next few years that might happen. I also know that it might not happen, right? So when I read that, it's triggering me to think, oh my God, I need to be careful of risk. And I know that because I'm mindful of, like, this is really triggering me. And if you know that, then you can make an informed decision. You say, all right, is this really possible? Or is this a new piece of information? Or is this just somebody promoting a story? In this case, it was somebody promoting a story. I'm not saying they're wrong, but it's not like it was backed on data. It was more like, hey, based on what we've seen in the past, in like the past 20 years, this has happened. The NASDAQ went down 75%. Like, yeah, but that was the tech bubble, so it's not really the same thing. So you have to always think about how it's making you feel. And is this coloring you in the wrong way? So that's all. That's why we do the show, is just help you think clearly and to make your own informed decisions. So Doug, where can people find more about you?
Well, and I forgot to add this before. One of the other reasons that I am starting to see people considering selling their house is to pay for college, right? Because all of a sudden they're like, wow, I tried to save, I didn't have enough money. I don't have enough money for one kid, and I still got to worry about the second kid. So this is a real burden for people. So if you want to find more about me, that's actually what I do. I help families prepare and plan to pay for college, specializing with families in the late stage college funding pressure cooker. That means you have kids already in high school. Get some, check us out, ProCollegePlanners.com. Download, you can actually ask me, email us at info@ProCollegePlanners.com. We have a free report where you can put in up to 3 schools, and you can actually get what the school, what they think you can afford to pay, what those scholarships might be available to you to those schools right now, and begin to get you some really valuable information. It takes about 5 minutes. Info@ProCollegePlanners.com. We'd be happy to send you the link.
Great. Thanks, Doug. Thanks for joining us on the show.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.